Last week, in APAC's asset and wealth management industry, we saw HSBC put a dozen markets on notice. DBS set ambitious growth targets. Hong Kong's SFC announced industry consultation findings regarding digital assets, and the profits of foreign banks in China hit hard. Let's take a deeper look at these, as well as other headlines and developments. Starting off in APAC, several private banks in APAC are reportedly requiring ESG funds under their offerings to comply with the European Union's Sustainable Finance Disclosure Regulation framework, compelling fund managers to expedite their compliance efforts, with UCITS products requiring classification of at least an Article 8 fund to be included under private bank offerings. The latest shift in the market for higher compliance reflects a greater need to report ESG-related information to clients, with distributors' desire to seek compelling and unique strategies, further fueling such change. This could potentially mean an increase in operational costs for asset managers and greater risks of regulatory action from both jurisdictions, especially given uncertainty surrounding SFDR, which saw more than 300 Article 9 funds recently downgraded, as well as a lack of clarity regarding what constitutes an Article 8 or 9 fund. Article 8 funds are reportedly the new norm for ESG products, which may explain the recent increase in Article 8 classifications across funds. Moving on, the Cayman Islands, long a favoured location for domiciling Asian hedge funds, is fighting back against efforts and initiatives from Hong Kong and Singapore. The island's financial services minister visited the two Asian financial centres to accelerate plans to establish an office in either of the two jurisdictions. The office would help investors set up and manage funds based in the Caribbean territory. No decision has been taken as yet on the location. The move comes after new fund structures introduced by both Singapore and Hong Kong have gained substantial traction in recent times, with numbers of Singapore's VCC rapidly growing since introduction in 2020, and Hong Kong's OFC structure also seeing increased interest. Something in favour of the Cayman Islands is the view that they are beyond the reach of Beijing. Whether the Cayman Islands can regain their position as the domicile of choice for Asian hedge funds remains to be seen. Next up, HSBC, a British financial institution with historical ties to Hong Kong and China, following previous and apparently continued pressure from Ping An, a Chinese financial conglomerate and active shareholder of HSBC, is reviewing its operations in as many as 20% of the countries it operates in to better focus on its Asian expansion. The British bank's continuing pivot to Asia has triggered planned sales of all or parts of its operations in several markets, including France, Greece, Russia, and Canada. Having weathered investor pressure, HSBC is now focused on a return on tangible equity in the mid-teens range for its Asian operations. Interestingly, it was the perceived lack of adequate returns that saw Ping An invest substantial time and resources in pushing for the divestment of HSBC's Asian operations, in the expectation the new unit would provide the returns sought. In 2022, HSBC saw a return on tangible capital of 10.5%, lagging the 13.8% average return of its Asian peers. HSBC recently re-emphasized the importance of its international network to Asia-based customers, with circa 60% of wholesale client business in Asia being cross-border. The cross-border nature of its business was a key argument for HSBC in rejecting calls for a spin-off. The lender has been pivoting to Asia and tagged $6 billion in investment across the region over 2021 to 2025, with China, India, and Singapore, among others, targeted as key engines of growth. In China, recent weeks have seen HSBC seek to improve its legacy planning offerings to private banking clients, an application for its insurance arm to receive a public fund distribution license, and an agreement reached with Shanxi Trust for HSBC to purchase the 51% of the public fund joint venture it does not currently own. Whether these and previous initiatives place the financial institution in a winning position to reach its targets remains to be seen. Moving on. As Web 3.0 continues to make tremendous developments, cities across Asia want a piece of this fast-growing digital asset economy. Currently, Of all major Asian cities, Hong Kong is coming out on top with its transparent guidelines and willingness to welcome companies to establish operations in the SAR. Many companies, from NFT developers to trading platforms and metaverse builders, have placed Hong Kong as their most desired destination, and platforms such as OKX and BitGet have already applied for operation licenses in Hong Kong, while crypto data provider Kaiko and crypto exchange Huobi are planning on shifting from Singapore to Hong Kong. Moreover, the failure of America's SEC to set clear regulations on the digital asset economy has resulted in many companies, notably Binance, contemplating giving up the US market. Accordingly, Hong Kong is capitalizing by building a friendlier business environment through a series of initiatives for businesses to thrive, including funding of $6.4 million and a new dedicated task force. By comparison, Singapore is following suit with its set of initiatives, but with a unique distinction. The city-state is focusing efforts on other areas of the digital asset economy, such as tokenization and distributed ledger technology, while excluding cryptocurrencies and crypto exchanges, which local regulators deem too risky for many investors and the financial system. However, it is noteworthy that other major Asian financial hubs, including Tokyo, Seoul, and Dubai, are also competing for a bigger share of the market with their own initiatives and incentives. With revenues from digital assets forecast to reach $102 billion by 2027, the benefits of getting the balance right are substantial. Next up, net fund inflows in Singapore over first quarter 2023 fell 81.5% to reach 897.58 million Singapore dollars, down from 4.86 billion Singapore dollars during the same period in 2022. The majority of net flows were into fixed income products, amounting to 710.87 million Singapore dollars, and equity and allocation products also saw net inflows. Investor sentiment for thematic equity strategies was mixed over the period, with investors favoring equity funds and selling off units in healthcare, alternative energy, financial services, and natural resources related funds. Money market funds continued to post net outflows, with Asia Money Market and the miscellaneous money market category recording the largest redemptions. This quarterly performance stands in contrast to Hong Kong, which saw net inflows of $1.8 billion over the same period, driven by billion-dollar plus months in January and February. Fixed income funds in the SAR also drove significant inflows, and it was multi-asset funds which saw the most in terms of outflows. Over to Singapore. On the back of a robust balance sheet and ongoing digital transformation, DBS, a Singapore bank, expects earnings to exceed 10 billion Singapore dollars within 5 years, a 20% increase from 2021's performance, with return on equity falling in the range of 15 to 17%. To achieve its objectives, the Singaporean lender is aiming for accelerated growth in high-yield, capital-efficient sectors such as wealth management, global transaction services, and treasury market sales. On the digital front, the lender's continuous digitalization has lowered costs over the last 5 years and increased efficiency. The wealth management arm saw substantial growth over 2022, gaining 3.8% to reach AUM of 297 billion Singapore dollars, with 23.7 billion Singapore dollars of net new money, and net profit increased 69% to 2.34 billion Singapore dollars. Targeting high potential growth markets such as India, Indonesia, China, and Taiwan is expected to significantly boost this business segment. Moving on, the exchanges of Singapore and Shanghai have signed a memorandum of understanding for an ETF Connect scheme leveraging the master feeder fund model to allow investors in both markets to access ETFs listed on each other's exchanges. This builds on the Singapore Shenzhen ETF Connect program launched in October last year, which has seen UOB Asset Management, the fund management arm of the Singapore Financial Institution, partner with Ping An Fund Management, the asset management arm of the Chinese financial conglomerate, to launch the first Singapore Shenzhen Master Feeder ETF, the assets of which skyrocketed 244% in the 2 weeks after its debut. Despite this, take-up of the program has been lacking, something which appears to plague many of the ETF Connect programs China has entered into. CSOP, a Chinese fund management company, plans to participate in the new ETF Connect, as well as the Shenzhen one, and is reportedly looking to bring a blue chip or dividend type product to Singapore. The SGX Group believes the partnership will explore new areas of cooperation between China and Singapore, including greater collaboration between issuers and enhanced investment options for investors. Singaporean investor interest in China equities ETFs has increased substantially, with daily turnover growing more than 50% during first quarter 2023. China and Singapore equities ETFs have 2.9 billion Singapore dollars in combined AUM as of April. The Singapore Exchange is looking to establish more cross-border trading schemes with China to better support the financing needs of Chinese firms. Next up, the MAS, Singapore's financial regulator and central bank, has launched the Financial Sector Artificial Intelligence and Data Analytics Talent Development Program, with the aim of building AI capabilities in the financial sector. The program will assess financial institutions' talent demand and work with training institutions to develop programs that meet the needs of the future financial landscape. Based on an informal survey, 44% of financial institutions indicated a shortage of AIDA talent was the biggest challenge in their adoption of AIDA. The new initiative seeks to address this shortage through two key strategies. The initiative will facilitate matching participating financial institutions to relevant training institutions. Subsequent to the second half of this year, a white paper will be published detailing the AIDA skills progression pathway and financial sector case studies. Up to Hong Kong. As part of the Hong Kong government's effort to attract family offices to domicile in the region, a series of incentives are set to take effect. Under the new tax scheme, eligible family offices with assets totaling more than 240 million Hong Kong dollars will be exempt from profit tax. In addition to tax incentives, revamping the capital investment entrance scheme and establishing art storage facilities at the airport are also part of wider efforts to compete against Singapore in the wealth management space. Moving on, the SFC, Hong Kong Securities and Futures Regulator, has published their consultation conclusions on proposed regulations for crypto trading platforms. Starting June 1st, guidelines for virtual asset trading platforms will come into effect, marking the commencement of license application acceptance by the SFC. This move marks the region's latest effort to retain its status as an innovative financial hub after Singapore cracked down on retail crypto trading in 2022. Traditional fund management companies have been early movers in Hong Kong's rapid push to become a larger digital asset hub, though the appetite among said managers to launch crypto-focused ETFs waned as they awaited the new digital asset framework. ZA Bank, a digital bank in Hong Kong, has revealed its ambitions in the space, announcing its plan to introduce virtual asset trading services for retail investors. Experts and industry observers believe that Beijing is positioning Hong Kong as its gateway to crypto and the wider digital asset space. Efforts to grow the space may be hampered by a lack of talent. Particularly, responsible officers have proven a barrier for crypto firms to find in order to operate, with only 95 of the circa 18,000 in the SAR having the necessary license required for a crypto exchange. Disclosures from the existing crypto product fund managers indicate that the existing digital asset exchanges have a total 43.1 billion US dollars in AUM. How much more this increases following the SFC announcement will be watched with avid interest. Next up, Invesco, an American investment management firm, has transferred its ownership of its MPF scheme to BCT Group, a major pension product provider. Under the agreement, BCT will become the sponsor of the scheme while continuing its role as administrator and trustee. Invesco will remain as the scheme's sole investment manager. The change will take effect in the fourth quarter this year, subject to regulatory approval from the MPF Schemes Authority and the SFC. After the transfer of ownership, Invesco can enhance its efforts on its core asset management business as an independent investment manager, while BCT is a natural home for the Invesco scheme, as the firm is already its trustee, administrator, and custodian. Invesco was a relatively small player in the MPF, comprising circa 1.9% of market share. The deal reflects a similar arrangement struck between Allianz and Manulife, a German insurer and a Canadian insurer respectively, back in 2020, when Manulife took the Allianz-sponsored scheme. And now to China. The seemingly boundless optimism and euphoria which accompanied financial market reforms back in 2014 appears to have fizzled out, with recent policy pivots from Beijing turning towards the industrial sector and away from capital markets. This in turn has seen the resurgence of Chinese banks at the expense of asset managers and other financial institutions, and banks now finance 63% of China's economy, up from 58% in 2017, a number that may increase despite the inefficiency of banks, as they are most opportunely placed to finance the industrial policy laid out by Beijing. Fund managers, once seen as a structural threat to banks, are unable to match the long-term orientation that banks can, and are more gun-shy to engage in certain areas which may be subject to sudden reversals and policy U-turns. This dominance may not be reflected in performance, with loans dictated by policy rather than commercial merit eroding margins, and larger banks may be called on to bail out their smaller peers. This has seen banks' return on equity fall from 20% from over a decade ago to 9.3% as of 2022. Despite efforts to diversify financial channels, equity and bond issuances only account for circa 12% of funds, with government-directed deleveraging initiatives, among others, responsible. Whether China's financial markets can reconcile multiple competing forces, such as low rates of returns for borrowers, low lending rates to SOEs and state champions, and a myriad other issues, will be watched with avid interest. Moving on. After a tough year with slowing IPO activities, China's 11 trillion renminbi brokerage industry is readying itself for more pain, as authorities disapprove of high commissions and high compensation. This is compounded by a severe stock market sell-off, which could inflict further damage to the financial health of players in the sector. CICC, a Chinese multinational investment manager, has cut the compensation of senior bankers by 40% as common prosperity kicks in. With the announcement coming after months of deliberation on how to navigate the social equality campaign, and rival firms such as Haitong Securities and CITIC delaying their payout announcements compared to previous years. Staff at foreign firms have also seen deep cuts to compensation, with managing directors at Goldman Sachs, Morgan Stanley, and Bank of America seeing total compensation drop by 40 to 50% on average. Commission rates for institutional investors could fall following State Council guidelines released in September last year that encourage brokerages and mutual funds to reduce service fees. This, combined with a hiring spree last year, which saw staffing levels rise on average 8%, saw listed securities companies' profits decline 34% over 2022. Next up, China's overhaul of its financial regulatory system has led to the establishment of two financial supervisory bodies, the Central Financial Commission and the Central Financial Work Commission. While their leadership has yet to be announced, both entities serve as a further extension of oversight beyond provincial levels. SFC is responsible in facilitating the coordination of financial supervision among other watchdogs and the central bank, while the CFWC ensures the financial system remains in line with the Communist Party of China's political objectives, theories, ethics, and discipline. Both are under the oversight of the Communist Party of China's Central Committee. Local and foreign financial institutions are no doubt thrilled to have more supervisory bodies operating in this space. Moving on. Profits at Western Bank's China-based units fell sharply in 2022 as COVID lockdowns and geopolitical tensions hindered operations, with financial institutions including Credit Suisse, Deutsche Bank, Goldman Sachs, Morgan Stanley, and HSBC all reporting losses, though HSBC incurred lesser losses compared to previous years. All of these banks collectively accounted for just 0.1% of the 395 billion renminbi aggregate revenue among China's 140 investment banks, despite an increase in listings in local bourses over the first half of 2022, though this figure does not give a complete picture of the revenue from China, as it excludes profits booked outside of the market for Chinese clients. This lackluster performance is a reversal from 2021, which was a record year for investment banks globally. The decline in fortune is attributed to US-China tensions, COVID-19 restrictions, China's property crisis, reduced onshore stock trading, restructuring costs, and increasingly fierce competition. Additionally, the market for Chinese companies listing in New York is decreasing after increased scrutiny from both jurisdictions, and the impact of common prosperity is also affecting onshore operations. Furthermore, in Hong Kong, Chinese rivals are challenging the dominance of global banks as they urge clients to hire both a mainland bank and an international one for Hong Kong listings. Nevertheless, the short-term headwinds are unlikely to cause Western lenders to leave due to significant investments made in hiring and acquiring licenses. In this regard, HSBC has stated it is fully committed to the mainland brokerage operation, and others like Citibank and Standard Chartered, a US financial conglomerate and a British bank respectively, are awaiting regulatory approval to establish operations. Western banks have spent years investing in small and often loss-making operations in China in the hope that a foothold in the world's second largest economy would eventually prove profitable. They're unlikely to give it up now, though there have been reports they are looking to scale back operations. Next up, high-profile raids and arrests carried out by Chinese authorities over the past few weeks have sent the foreign investment community into a state of confusion and cautiousness about what can and cannot be done at a local level. The raids were done on 4 offices of Capivision Partners on the grounds of leaking sensitive information to foreign firms. Raids and questionings were also undertaken at Mintz and Bain & Company. Under the 2021 data security law, all cross-border data that poses a risk to national security and public interest have to undergo self-evaluation and review by regulators. However, there is ambiguity about what constitutes sensitive information, given that the law is still undergoing constant updates. The newly revised anti-espionage law that will take effect on July 1st will further add investor confusion on what is defined as national interest. Chinese regulators are reportedly in discussions with global firms to provide clear guidelines of what data cannot be transferred offshore. Nevertheless, based on recent geopolitical events, foreign firms operating locally will have to anticipate further separation between their onshore and offshore units. Moving on, Morgan Stanley's retail fund joint venture recorded a loss of $7 million last year, compared to most peers which saw profits. Among the 10 fund houses that posted losses, Morgan Stanley's fund unit was the 6th worst performing. The disappointing performance comes as Morgan Stanley struggles to establish itself in the domestic market, despite being one of the oldest joint ventures. By contrast, JP Morgan's joint venture, established merely a year after Morgan Stanley's unit, now has 126 billion RMB in AUM. Analysts believe Morgan Stanley's lacklustre performance is attributed to the competitive landscape of the domestic fund market, which has been dominated by a handful of giant firms. Up next, after agreeing to acquire Credit Suisse, UBS is putting its application for a wholly owned mutual fund company to a halt. The rushed takeover of Credit Suisse has added complexity to UBS's endeavors to expand its fund management operations in China, which permits companies to have one majority and one minority stake. UBS currently holds a 49% stake in a joint venture with SDIC Taikang Trust. However, post-acquisition, UBS will also hold the 20% stake that Credit Suisse had with ICBC. As such, the Swiss bank is halting its mutual fund application to decide what to do. Based on the size of the 20% stake with ICBC, UBS may disperse that stake given that it has insignificant influence regarding the direction of the business. Finally, the Greater Bay Area is leading China in green and sustainable finance, with green bonds and loans jumping 53% and 44% respectively in 2022, compared with 39% nationwide, according to speakers at a recent GBA forum. Green and sustainable bond issuances have doubled to 56.76 billion RMB year on year in first quarter 2023, as per the Hong Kong Green Finance Association. Hong Kong can guide more international green funds to invest in the mainland's green projects by combining the strengths of Hong Kong as a financial centre and Shenzhen as a technology centre. China needs an estimated 100 to 200 trillion RMB in investment to reach its targets of peak carbon emissions by 2030 and to become carbon neutral by 2060. To help reach these financing targets, Beijing has an ambitious plan to create an integrated economic and business hub in Guangdong by 2035, turning the region into a green finance hub with Hong Kong as the sustainable financial centre of Asia Pacific. Green and sustainable bond issuances in Hong Kong jumped to $80.5 billion in 2022, up 40% from 2021. This accounts for 35% of Asia's total issuance. So, those are the key headlines and developments that we saw over the last week. Do let us know your thoughts in the comments below, and if there was anything that we missed, tell us about it. A special thanks to Sam for helping in this week's script. Thank you all for watching. Hope to catch you next time.